So this is the agenda of the day. What we are to get from this particular class, the purpose of financial statement, the balance sheet, the income statement, the statement of retained earnings, statement of cash flow, notes to the financial statement, fundamental concepts and assumptions, accrual versus cash basis accounting, standard for comparison. So this is what we are doing today. At the end of this meeting, we should at least get something out of this. We must understand the whole agenda. We have to understand everything so that we don't waste our data. Thank you. So we move on. So the primary financial statement, the basic fundamental financial statement is the balance sheet, the income statement, the statement of retained earnings, and statement of cash flow. These are the basic financial statements that we have. It is 4. We have the balance sheet, we have the income statement, we have the statement of retained earnings, and statement of cash flow. We'll go into details of this. So primary financial statement answers basic questions include: what is the company's current financial status? What was the company operating results for the period? How did the company obtain and uses cash during the period? So basically, this financial statement tells us how the company is performing, the current assets, the liability of the company, how they are using cash, how cash is going out of the company and then cash is moving in, which is the inflows and outflows. So these are the basic questions that financial statements answers about companies. It's let us know basically this about the company. So the balance sheet that we are tackling, that is the first one. Summary of the financial position of a company at a particular date. So if you see any balance sheet, you will see that balance sheet of so and so company on maybe as at 31st December 2010, 31st December 2021. So it's at a particular date. It is telling us the position of the particular company at a particular date. So assets. So it shows us the asset that the company has, which is cash, which is account receivables, inventories, land, building, equipment, and intangible items. So some of the intangible items are the patents, the goodwill. Those are intangible fixed assets. So fixed or the assets, you see they have arranged the assets from cash, account receivables, as how liquid they are, how easily they can be converted into money. So even on the balance sheet, you may see current assets first, which is cash, inventory, cash at hand, cash at bank, and then we have inventories. So before you come to fixed assets, which are the land and building, machineries, equipment, and those stuff. And then sometimes you may have the patents and then the goodwill, which is the intangible fixed assets. And then this balance sheet also tells us or shows us the liability, account payables, the money that we need to pay our creditors, or our suppliers, the money that we need to pay them, note payables, and mortgage payables. So it shows us the liability, what the company is owing, when are they supposed to pay all this. It's also divided into the long-term liability and then short-term liability, which the short terms, we need to recover them within a financial year, which is 12 months within a year, which when it goes more than a year, then it means it must be classified under the long-term liability. The same thing to the assets as well. Then we have the owner's equity, net asset after all obligations have been satisfied. So the owner's equity in other ways is the money that owners brings to the company. So the balance sheet, these are the questions that it answers. What are the resources of the company in terms of assets? What does the company have? What are the company's existing obligations? What are the monies that they need to pay? So resources, they have this, they have cash at bank, cash at hand, this. What are the obligations they need to perform? The money that they need to pay their suppliers or salary and all those things. So the obligations that they need to perform. And then we have what are the company's net assets? Net asset after deducting everything, what is the company having as their assets for them running the business? So that is the basic questions that balance sheet answers when it comes to company performance. So we have the accounting equation. This is the basic accounting equation that we have. Asset equals liability plus owner's equity. This asset is the resources that the company has or the company have. The liability, the liabilities are what the company owe. And then the owner's equity is the money that the owners are bringing. So you can see that liability may be that we have borrowed something. You know, we have borrowed something. What we have borrowed plus what owners has added or want to start with a business. When we add all those, it must be equal to the assets that the company has. Let's assume that we are starting a business. The owners bring 20,000 Ghana cedis. So basically, in the first place, the accounting equation will be asset equals owner's equity. Asset equals owner's equity. Going forward, the company decides to go and acquire a vehicle or a van or equipment which we have not paid, or we want to acquire it on credit. So now, if you bring this van, which is liability, when we add the van to what the owners has pumped into the company, it must be equal to the asset that the company has. Now, the company have the van, which is a fixed asset, and then the company has the 20,000 Ghana cedis from the owners. It must be equal to the assets that the company has. That is why the basic accounting equation is asset equals liability plus owner's equity. So basically, resources is the asset that the company have used to generate revenue, and then creditors claims against the company. That is the liability. What they claim that, oh, you have to pay us this. You came for the van, you have not paid, or you came for the equipment, you have not paid. That is a claim that creditors has against the resources. And then the equity is the owner's claim against the resources, against the assets. The asset that you have in the company, owner says that this is our portion. So when you add that, the liability plus the owner's equity, it must be equal to the asset.
Sammy, please, can you hear me now?
Please, I can hear you. Can ask your question.
Sammy, please, can you put what you just said on the
slides before this one? You said the fixed asset, the liability is a fixed asset. I don't understand, because I know liability is something that is going out. The vehicle is a liability, but you are saying it's a fixed asset. I want the explanation of the fixed asset and the liability, please.
Okay, thank you. I didn't say the liability is the fixed asset. All what I'm saying is the asset is equal to liability plus owner's equity. Now, whatever you acquire, the liability is the creditor's claim against your resources. Now, the resources that the company has is the asset. So in case you go and buy a van, the van is an asset. But if you bought it on credit, it means you owe your liability. You have a liability to pay, obligation to.
Okay, please. So it becomes liability when it's on credit basis.
Yes. So
okay,
because you bought it on credit, it's a liability to you. So you need to pay. And when this van comes to the company, it tends to be assets.
Okay.
So your asset has to be equal to the liability and the owners plus the owner's equity.
Okay. Thank you.
You're welcome. Please, any other question? Okay. This is basically an example of balance sheet that we are seeing. We have the assets, we have the cash account. So under the assets, we have cash, account receivable, and then we have land. On a normal balance sheet, you may not see assets. You may see current assets. Then they will bring cash, account receivables, bank, and then inventories. Then they will come down to fixed assets. Then they will bring land and those fixed assets. Liability also, you will see current liability. They will bring accounts payables, note payables before they will bring, and then the long-term liability that you need to perform. So this is basically an example. So it must be equal to. So if your asset is not equal to your liability, then the Hello, Poshokwe.
Sorry.
Yes, please ask your question.
Please, I want you to differentiate between the current and the non-current assets. Then what a fixed asset is. Okay.
Okay, thank you. So when we say current assets are assets that can be easily be convertible within a particular financial cycle, which is 1 year. So within a year, any asset that can be converted into money is current assets. So under every current asset, you will see cash, accounts receivables, you see cash at hand, cash at bank. So this, and then you see inventories. It means all these assets can be converted. So the fixed assets, they are assets that are for long term. We don't convert them in one financial, in one accounting cycle. Same thing to the liability. Current liabilities, they are liabilities that we need to we need to perform, or the obligations that we need to do within one financial cycle. But the long term, it may be divided into maybe 3 years. You have a liability to pay, you are paying it for 3 years. Then this becomes a long-term liability. You spread it. But then whatever you will pay within that particular year is the current. Let's assume that you have 10,000 to pay. This 10,000 has been spread to 3 years. The 3 years, maybe the first year you are paying 500. The 500 becomes the current liability, but the rest become the long-term liability. Thank you. If only you're okay with.
Sammy, I'm sorry to come in again. And you said that an inventory is a current asset.
Yes, please.
Okay. And I know inventories are, let's say, items that are yet to be sold out.
Yes.
Okay. So how can you convert an inventory can be a current asset like a cash in hand? Is it when you sell it out and then you receive the money?
Yes. So with this, we are looking at how liquid these assets are. So when we are arranging them, mostly we bring the cash first, and then we bring accounts receivables, and then we bring cash at bank, and then inventories are mostly last, because that is the list of the when it comes to the liquidity of the assets, that is the least among the current assets.
Thank you.
All right.
Yeah, okay, thanks.
Any further questions before we move on? Okay, let's move on. So classified and comparative balance sheets. So it is distinguished between current and long-term assets. So the balance sheet distinguished, it shows us clearly which of the assets are current, which of the assets are long-term. And also it shows us which of the liabilities are current and which of the liabilities are current. So this is basically how the balance sheet tells us about a company. It tells us about a company. So listed in decreasing order of liquidity. So when we are doing this, when we are performing this particular balance sheet, when we are doing this balance sheet, we list it in terms of liquidity, how liquid these assets are. That is why mostly we start with cash. There is no, unless with the standard of reporting, we have the US GAAP and then we have the IFRS. So with the US GAAP, it's quite different from the IFRS, which the IFRS is being performed by the people outside US. But the US GAAP, mostly the US company uses it. Well, unless for them, they can use it, they can do it, the most liquid one will come last instead of coming first. So that is the only difference. But when it comes to the normal accounting that we have, we arrange it from the liquid, the least or the most liquid. So we start with cash, which is most liquid. That one has been converted already. Then we have cash at bank, and then we have cash at hand. Sorry, start with cash at bank, stock or inventory. Then there it goes. So the comparative, so financial statement users can identify significant change over time. Let's see this part. So with a balance sheet, it helps us to identify the significant change over time and help us to know the performance or the standards of the company. So balance sheet limitation. So these are the limitations of using balance sheet. That is why in valuing a company or checking how liquid a company is, we don't only use the balance sheet, but we also use the income statement and then the cash flow statement. So the assets recorded at history value. So in financial statement, we record the asset in history value. When we bought the assets, that is the amount that we used to. When assuming we acquire a land, 40,000 Ghana cedis, that is the amount that we are going to value it. When we acquire a van for 30,000 Ghana cedis, that is the amount that we are going to value it. Even when years changes, the only thing that comes here is depreciation. Now, when we have assets, we depreciate. I think with land, we have a name for it, but I forgot it. But with van, you depreciate. With fixtures and fitting, you will depreciate. So the amount recorded or the value recorded is a history value, how we bought it. It's only recognized asset that can be expressed in monetary terms. So with this balance sheet, if that particular asset cannot be quantified in monetary terms, it will not be covered in the balance sheet. So it means you have an asset, but they can't cover it because they can't quantify it in monetary terms, which is going to help, it's not going to help. It is going to deceive other people because they will not get to know the true value of the company because one or two assets has not been captured in the balance sheet. And then also owner's equity is usually less than the company's market value. Owner's equity is usually less than the company's market value. So let's go to the second one, which is the income statement. It shows the results of a company over a period of time. What goods were sold or service performed that provided revenues for the company. So this tells us that how is the operations of the company doing? How are they performed? What goods has been sold? What costs were incurred in normal operation to generate the revenue? So the income statement tells us that the revenue that we have generated, how much is an expense? What are the earnings of the company or the profit of the company? So this is basically, it tells us the profit of the company, whether they are making profits or they are making loss. So revenues are the assets. Cash or AR. The AR stands for account receivables created during the business operation. So in this, you may have some of the money not paid that you are expecting. And so that is the AR, account receivables. And then expenses. Expenses, cash or account payables consumed during the business operation. So how much did you spend during your operations? And then you have the net income or the net loss. That is the revenue minus expenses. So when your revenue is more than your expenses, it means you are making profit. But when your expenses are more than your revenue, then it means when your expenses are more than revenue, then it means you are not making any profit at the end. You are rather losing. So this is basically an example of the income statement. We have the revenue. So revenue, we have sales. We have other revenue. Other revenue can be maybe other money that you have gained from other companies, as the man explained. So then we have your total revenue. But with this, mostly when we are preparing this, after getting the total revenue, we less cost of goods sold. When you less cost of goods sold, what you will get is your your gross profit. Total revenue minus the cost of goods sold, you get your gross profit. After getting your gross profit, then you come to other expenses. Then you come and less all the expenses, maybe administrative expenses, operation expenses, then you get your income before tax. Income before tax. That is the EBIT. But this one is EBT, income before tax. Then you come and less your income tax. Then you get your net income. Total revenue minus cost of goods sold, you get your gross profit. Less all expenses and get your income before tax. Less the tax and get your income or your profit or your net loss. So I think this is basically, they did it for 2010. So 2010, they were saying that their sales were 100, other revenues were 30. So it means their total revenue is 130. Now they are telling us that cost of goods sold is 62, operating expenses 16, income tax is 20, total expenses is 90. And so when they add all this, their total expenses is 98. You less 98 from 130, they had 132. Sorry, they had $32. So this $32 is their profit. And then this is for 2010. Their sales were 85. Other revenue 15, making 100. They add all their expenses and less is from their total revenue. And then they get their profit. So here we go to statement of retained earnings. Statement of retained earnings. To calculate for retained earnings, you have your net income minus dividend paid is equal to ending retained earnings. So,
hello.
Yes, sir.
The beginning retained earning, is it the profit, the net income from the income statement?
The beginning retained earnings. Let's assume that you are doing it for this year. This is we are in 2001. 2021. So the beginning retained earnings will come from the ending of 2020. So the ending retaining earnings in 2020 becomes the beginning retaining earnings in 2021. Please, are you okay?
So I mean the beginning retained earning, which earning is it coming from?
And I'm saying,
is it from
the beginning retaining earnings? Let's assume we have 20.
Sammy, can I help him?
Yeah.
Yeah, so the example that we just did, the 2010, the net income was 32. Okay, so if we are doing the retained earnings for 2012, then the net income will be the $32. Sammy?
Yes, so then the net income will be $32, but the beginning retaining earnings here will be from the previous year. When you go to the balance sheet,
yes.
So we have, okay. So let's see example here. We have 2010 on my right. That is December 31st, 2010, which is the red arrow. Let's see where the red arrow, where it starts from. The December 23rd, the December 31st, 2010. That is for 2010. And then let's see where the blue arrow is. The blue arrow is for 2011. So let's see the retained earnings here. We have cash, 80,000. We have orders, 140,000, 55,000. And then the total is this. Let's see liability. And then let's see capital stock. Now the retained earnings is here. So retained earnings is 760,000. Sorry for my words, 760,000. This is the retained earnings for 2010. But when we come for the statement of retained earnings, you have to bring the beginning, but the beginning will have to be for when we are doing for 2012. Now we are doing for, sorry, it's 2010 and 2011. So 2011, when we want to do statement of retained earnings, we have to bring our beginning. This statement of retained earnings is being prepared in 2011. So in this 2011, when we want to get our beginning retaining earnings, we have to go and pick it from the ending retaining earnings of 2010, which is 760,000. So they have it here. Now the net income, we have to go and pick our net income, which the net income is here. When you are preparing the income statement, we have your revenue, the yellow box, the revenue, you have your expenses, and you have your net income. So this is our net income. Then we bring our net income. Now we have to less the dividend paid. The dividend paid was not specified in this slides. So they less the dividend paid. No, sorry. Right. So know that this, the beginning retained earnings plus net income minus dividend gives us the current retained earnings. If we are getting the formula, this is the formula.
Okay, so the retained earning is gotten from the residual of the dividend paid to the shareholders.
Yes, you see,
okay.
After the dividend that we need to pay for them, we may need to retain some of the money. Assuming say we finish everything and we are to pay the shareholders 20,000, but then we need money to run the business. Then we may decide that, okay, we are going to retain, or we are going to keep 1,000 of everybody's money. So it means they are going to retain 50% of everybody's money. That is the retained earnings. So still the retained earnings belongs to the owners, and it increases the owners, their equity in the business. Please, are you okay?
I get it.
Okay. So always the beginning retained earnings, you get it from the other years. It's like account. When you close account, you get the beginning from the previous year. So let's go back. We are far forward. So this is the formula: beginning retained earnings plus net income minus dividend paid is equal to the ending retaining earnings. And know that the net income, it increased the assets of the company. It also increased the retained earnings, and it also increased the equity of the owners. But when you less the dividend, because it's the money that we are going to pay to them, let's assume we have 1,000 as dividend that we need to pay to them. When we don't pay to them, that is when it is coming to increase our assets. But when we pay to them, then it means our assets will decrease. Then there will be decrease in retained earnings as well, because it is part, the dividend as a whole that we need to pay to them, that we have decided that we are not going to pay all, but we are going to pay some part to them and keep part of the money in the business to help the business run. So an additional fund statement that identifies changes in retained earnings from one account period to the another. So the statement that we saw, it shows us the changes in retained earnings from one year to the other. Of cash flow, it reports the amount. It reports the amount of cash collected and paid out by a company in operating, investing, and financing activity for a period of time. How did the company receive cash? How did the company use its cash? Complementary to the income statement. So it helps, it is part of the income statement. It helps us to be able to interpret the income statement well. Indicates ability of the company to generate income in the near future. So how did the company receive cash? Did they sell their assets, or did they sell some goods to receive cash? How did the company use the cash? Did they pay some creditors? Did they invest in other activities? This is what the statement of cash flow answers. So statement of cash flow, you have cash inflow. Before you get cash in the company, unless you sell goods or service. Now you have goods that you sell to other people, or you have service that you render to other people. When you render all these services, then there's money that come into the company. It is when you have inflows. When you sell other assets or by borrowing, when you sell assets, maybe you have car that you want to sell, you sell the car, it's an asset. You sell the van, it's an asset. And then you get money, or you go and borrow additional money. It means there are inflows, money coming to your business. When you receive a cash from investment by owners, so when you invest and you receive a cash, it is when money is coming to the company, which are the inflows. But the outflows, when you pay operating expenses, advertisement expense, general expense, light and heating, prepaid, when you are paying all these expenses, the money is going out of the company. When you expand operation or you pay loans, money that you borrowed, then it means money is leaving the company. You pay owners a return on investment. Owners invest and then you are paying them return on it. Money is going out of the business. So it basically shows us the inflows and outflows of cash in a particular company. So much clarifications of cash flows. So these are the operating activities, basically daily activities that we perform, transactions and events that enter into transactions of net income. So operating activities are activities that we do every day, some purchases that we do regularly. Those are operating expenses. And we have investment activities that we invest in maybe securities, or we buy plants and equipment for a long term. You buy land, all those things are investing. You are investing into that because you are not going to get it today. And then we have the financial transactions and events whereby resources obtained from or repaid to. So whereby owners still invest money in the company, those are financial activities, or you go and borrow money to be able to expand your business. These things are financial activities. So these activities, we need just to watch them close. They are closer, but investing is buying equipment, sales of securities, properties, plants, and other assets not generally held for resale, and the making of collection of loan. And then the activities that we do daily are the operating activities. And then financing, by borrowing extra money to expand your business, or owners reinvesting money into the business. So the activities here, the operating activities, they are giving us example here. Sale of goods or service, sale of investment in trading security, interest revenue, dividend received. So these are activities that brings money to the organization, which are operating activities, and activities that takes money from the company, which are operating activities, are inventory payments, interest payments, wages, utility, rent, taxes that we pay, all takes money from the business, which are operating activities. Then we have investment activities. Investment activities, sale of plants. You see, this plant, sale of plants, it brings money in the company. It's an investment activity, but whilst we are selling it, then it is bringing money to the company. Sale of security, other than trading securities. Then we have collection of principal on loans. This brings money. We have invest money that we are taking principal on the loan. Yes, please. Someone hand is up. Okay, please ask your question.
I wanted to ask that here. For like the cash inflow, the transactions, the activities that's going on under the sale of plant assets and sale of securities. When I compare it to the midterm, they say they say we should indicate the accounts the transactions affect. Can you help us with maybe the sale of plant asset, the account is affecting and all that, or we'll come back to that one later?
Okay, thank you. So the sale of plants, when you sell plants, it affects two. It will affect sales and then the person taking the land. So you credit, when you sell, you have to debit sales and credit the person taking the plant, unless we have a particular transaction that you want us to look at. But when you sell a plant, you are getting money. Unless maybe if you have a typical transaction that you want us to, then we can look at the transaction and then identify the two accounts that it affects.
Oh, okay.
So if you have
that's fine.
a particular transaction, we can just analyze it. When you bring it to you, identify the two accounts that it's affecting. Please, someone's hand is up. Portia.
Sammy?
Yes, madam.
I think with the question that Ato asked right now, the transaction that we can use to identify, or let's we use the question that we had in our meeting.
Yeah, that is why I'm saying if we have a particular transaction, unless maybe we want to pause this and go and discuss that one and go and bring that transaction.
No, that can be later.
Yes. So I think if we have a particular transaction, we can analyze and see the two accounts that it's affecting, which one is being credited and which one is being debited. Watch out, your hand is still up. Do you want to ask a question still? Okay, thank you. So when you okay, Gavin.
Yeah, so I just wanted to make an addition that even when it's just like this, a sale of plants, okay, there are two things that will be affected. One, your fixed assets of plants will decrease and there will be an increase in.
Sure.
Even when they've not made any specifications, like mention a creditor's name or something, the basic standard will be there will be an increase in cash and a reduction of fixed asset of plants.
Sure. Thank you. Thank you for
contribution.
Okay. So then we have the outflow side, which is the purchase of plant. When you purchase plant, cash goes out of the company. When you purchase security, cash goes out of the company. When you make any loan or other entities, cash goes out of the company. So, and then financing activities, issuance of owner stock. You see, when you issue stock or you issue shares or you borrow money, it brings money to the organization. But when you pay dividend or you repay principal on loan, then or you pay treasury stock or you purchase them, money is being taken out of the company. So when you use money to go and invest, money is being taken out of the company. So these are the activities. We can just go through them and then. So this is the summary of it. All these three, the operating activity, investing activity, financing activity, all these three either brings money to the organization or takes money out of the organization. So it's either what you are doing under the operating, investing, or financing, bringing money to the organization, or taking money out of the organization. So we have statement of cash flow analysis. Statement of cash flow analysis. We have the operating to be a positive, investing positive, this positive, building piles of cash. That is possibly looking for acquisition. So with this part, we are not sacrificing any of the activities to pay the other one. Operating cash flow being used to buy fixed assets and pay debt. So with this one, you have operating cash. You have the operating cash. That cash is the one that you are using to pay your investments and you are using to finance. So you are using that one to buy fixed assets and you are using that money to pay debt. That is why the investing aspect is negative. That is, you are buying fixed assets with the operating cash. And then the financing aspect also is negative. Then it means you have debt that you need to pay. You are using the operating cash to pay. And we have the third one, which is the operating is positive, investing is positive, and then financing is positive. It means you are using operating and investment to pay. or to cater for financing. So operating cash flow and sales of fixed assets being used to pay debt. And then the last one, we are using the financing and then the operating to cater for the investments or for assets. So either we are borrowing money and we are using the other money that we have to buy new assets or to expand the business. So the example company statement of cash flow, December 31st, 2009. So 2011, sorry. So here they are basically telling us that cash flow from operating activity, that is the receipt, whatever they receive was 48. That is the money they receive. And then payment that they made from operating activities is 43. So it means when we less 43 from 48, we are getting 5. From the investment activity as well too, they receive 0. They receive nothing. And then rather, we made payment of 4. So when we see the bracket, it means it is a negative to the company. And then, the activity from financing, we receive 10, and then we made payment of 6. So it means we have 4, which is being positive. So when we add all this, because this 4 here from the investment activity is negative, it will take away the 4 from the financing activity, which at the end we have 5 as our net cash flow. So in general, let's analyze this. Please, Madam Loretta, do you want to ask any question? Okay.
Samuel was like, where from the 5, the net?
Okay, the 5, the net cash flow, right? Okay.
Yes.
Okay, so these 5, basically, let's check here. The activity from operating activities, we receive 48, and then we made payment of 43. So it means that here we have 5. Let's say if it is dollars or Ghana cedis, we have got 5 Ghana cedis here as extra because we received 48 and made payment of 43. So it means we have extra 5 cedis here. From the investment activities, we didn't receive any money, but we made payment of 4 Ghana cedis, which is in brackets, which is negative to the company that the company need to pay. And then from the financing activities, we receive cash in these activities, 10 Ghana cedis, and we made payment of 6 Ghana cedis. So it means we have 4 Ghana cedis left. So here, these are the monies that we have left. We have 5 cedis, but we are owing 4 cedis, and we have another 4 cedis. So whatever we have here, the money that we have with us is the 5 plus the 4, which is 9. But know that these 9 cedis that we have, we need to pay this 4 from the investment activities, which is the 4 in the bracket. So when we need less the 4 from the 9, we are having 5.
Okay, thank you.
You're welcome. So let's quickly analyze this and then let's see. So we have cash flow statements. So the first one is the operating activities, the cash OP dot operating activities. And then the investment, so whatever in the bracket means that we are owing. So with the operating, we have money from there, but with the investment, we owe 1,188,000. That is what we owe. And then from the financing activity, this is what we have. So when we total this, when we add the 973,000 plus 245,000 minus 1,188,000, this is the money we are having. We are having 30,000. And then the 30,000, we have a beginning cash. This beginning cash was taken from this balance sheet, the 2010, the cash here, that is 80,000. So when we add the 80,000 to the 30,000, we have 110,000 as our ending cash. The beginning cash was taken from here, the balance sheet, the 2010, which they are showing us the arrow. So let's see the income statements. The income statement, we have revenue of 12,443,000. And then we have expenses, so and so that we expenses that we incurred during our operation. So when you less the expenses from the revenue, that gives us our net income, which is 864,000. Now, let's go to our balance sheet, the 2011, the one on the right. We have our beginning cash, 2011. You see, 2010, in the balance sheet, we have 80,000. And then we have net increase here, making us, at the end of 2010, we have 11,000. So this 11,000 is the money, the ending cash that we are going to use in the balance sheet. That is why in the 11, we have 110,000 here, which is the ending cash for 2010. Then we have others, they didn't specify. So when they told us this is what we are having, and then we have liability that we needed to pay, obligation that we needed to fulfill. Then we have capital stock, that is investment. And then we have retained earnings. Retained earnings, 1,222,000. Where from this retained earnings? We got this retained earnings from the statement of retained earnings. This statement of retained earnings, let's see, now let's analyze the statements of retained earnings again. You see retained earnings, 31st December 2010, they had 760,000. This 760,000 in 2010, when you go to the balance sheet of 2010, which is the one at the left hand, you see retained earnings of 760,000. That is the retained earnings here. That is the beginning retained earnings. And then the net income, which when we perform our income statement, the yellow box, we had 864,600. That is the net income. That is the net income. Now, the retained earnings here, they pick this straight because the difference between this, when you add the liability, 2011 I'm talking about, when you add the liability and then you add the capital stock, the difference between the liability, when you add the liability and the capital stock, the difference between that of this total, the 5 million, is the 1,224,600. So that becomes our retained earnings. So to be able to know the dividend that was paid, which was not specified in this area, which was not specified here. In other case, it may be specified that we will if they receive 1 million, you will keep maybe 40% of it or 50%, but it was not specified. So here, in able to know the retained earnings, unless you add this and then you less from the retained earnings for 2011 before you'll be able to get the 400,000. So when you add the 760,000 plus 864,600, when you add it and you less 1,224,600, you get your dividend paid, which is 400,000. Please, any question? Oh, okay.
Yeah, bro, so the retained earnings is the capital stock money as the liability, or
The retained earnings,
yeah, on the balance sheet. Liability,
2011.
liability is 2,970,000. Capital stock that. So it means they subtracted the capital stock from the liability.
No. The whole show is, you see that the balance sheet, the top here is the asset, the cash and others, which is the total 5 million is the asset. Now, for a balance sheet to balance, the assets must be equal to the liability. So here we have the liability to 2 million. So you add this 2 million to 2,860,400 to the 1 million, which you are going to get 3,860,400. It means this is not equal to the total here, the 5 million. So when you less the 3 million, which is the addition of the capital stock plus the liability, when you less it from the total asset, that gives you the retained earning. Please, are we there? Samantha, please, are we there?
Yeah, it's fine. It's fine.
Okay. I think on a normal situation, all the things must be stated, you understand, so that we know how much we are paying as dividend and how much we are retaining. But I think they simplified it to explain things to us. So some informations are missing here. Okay. So note to the financial statements. Notes are used to convey information required by the GAAP, that a general accepted accounting principle, or to provide further explanation. So we add notes to the balance sheet or to the income statement to convey some information that are not covered, to be able for users to understand the whole show, the reason why we came about all this. So note to the financial statement. It's 4 general types of notes. Summary of significant accounting policies. That is assumptions and estimates. We have a lot of accounting policies. We have the accrual, we have the owner's entity, we have the going concern concept. So these notes may carry all this. Additional information about the summary total. There may be additional information which has not been captured in the balance sheet or the income statement. So this is where you find the notes. You find the information, you find it in the notes. Disclosure of important information that is not recognized in the financial statements. So these notes help us to know some information that are not in the financial statement. Supplementary information required by the Financial Accounting Standard Board or the SEC. So these are supplementary information that are required by this group that you add it so that at least users will be able to understand the whole financial the statement or the balance sheet that you have prepared. What are the financial concepts and assumptions? We have separate entity concept.
But
yes, sir.
Please, can you go back? Please, the summary for I say the supplementary information required by this. Can you give me some of the information?
The supplementary information required by, you see, these people are regulatory bodies, and then they required some information. The information is disclosure. It may be even one of this, the disclosure of significant accounting policies. You can't just prepare anything and leave these informations out. You have to disclose this information to the users. So these standard bodies or these regulatory bodies require that you add those information to it. And then, yes, if in terms of the GAAP and then IFRS, so that they will be able to even know the the standards that you are using. Are you using the FIRS or you are using the US GAAP? Because under the US GAAP, they have their own way of preparing their balance sheet and income statement. And then with the US GAAP, they have some strictness in their preparation. So these informations are required by these bodies for the users also have some knowledge. If they just leave you like that, you may also decide to come up with anything that you want.
So when you are preparing such statements, you state it beside it.
Yes, they have the notes. The notes attached to it. So at the back or at the end of every statement, you have notes. So that place is where they will explain some concepts which may be the accrual concept, the going concern concept in that particular side. For you, the reader, to understand that, okay, they did this here or they did this here. You may even get to understand that they are telling you at the end that they are making so and so profit, but on the real, it's not really impactful. It is where that you'll be able to deduce all those information from.
So if they are not tallying with the standard board, they can also state their legal requirement note attached to it, or they don't do that one?
No, you see, we have a standard. Accounting is accounting. You can't bring your standard. You can't bring your way of preparing it, you understand? Unless it is two. Either you are using the US GAAP or you are using the FIRS GAAP. So, the FIRS. If you are using that, is the IFRS. So, if you are either you are using these two, but you can't bring your own accounting principle like after your current assets, you need to go to fixed asset. Then you say, oh, after my current asset, I'm going to liabilities. No, you can't bring something which is not in accounting field. Accounting is standard. It's across board. It's a global something. Whatever you are doing here, somebody is doing the same thing in Germany. Somebody is doing the same thing in Togo.
Yeah, that's fine.
Okay. Thank you. So these are some concepts and assumptions that we use in preparing this accounting statement or the financial statement. We have the separate entity concept, we have the arm's length transaction, we have cost principle, we have monetary measurement concept, and we have the going concern concept. We will explain this later. So we have the entity concept, which the entity is the organizational unit for which accounting records are maintained. So that is the entity. But when it comes to the separate entity concept, it shows that the activity of an entity are to be separate from those of the individuals. So with the business entity concept or the separate entity concept, it tells us that the company is different from the owner. Whether partnership, sole proprietorship, or corporation, the company is different from the owner. That is the going concern concept. I think I don't have the book here, like I will share with you. Right? Basically, that is the business entity or the separate entity concept. It's just clear that the business is separate from its owners. That is the individual running the organization. And then the cost principle. All transactions are recorded at history cost. That is what we were saying, that is some of the limitations of the balance sheet. The balance sheet, they just record all assets at history cost. So these are some of the principles that they use in preparing this financial statement. All transactions are recorded at what? Cost, history cost. History cost is assumed to present the fair market value of the item at date of transaction because it reflects the actual use of resource by independent parties. So that is the history cost. The fair value is maybe the market value or the value that everybody assume or is assumed that everybody should be around. That is the fair value. So they are telling us that if you use this, it really helps because it reflects the actual use of the resource by independent parties. So these are all principles that are being used in preparing our accounting statement. We have the monetary measurement concept. Accountants measure only those economic activities that can be measured in monetary terms. So even in accounting definition, they will tell you that they only measure economic event that can be quantified in monetary terms. So anything that cannot be quantified in monetary terms will not be measured. We can use it in accounting field. Even if you have a car and we can quantify it in monetary terms, then it means we can't, unless something that we can quantify it in monetary terms. So they measure only those economic activities that can be quantified in monetary terms. The listed value may not be the same as actual market value because of inflation and then measurement issue. How you may measure it may be a little bit different from how other people may measure it. So there will be some slight differences somewhere. And then we have the going concern assumption or the going concern concept. So this thing tells us that the entity will have a continuous existence for the foreseeable future. With this particular concept, it tells us that the company is never going to liquidate. They are going to be in the system for the foreseeable future. So when they are telling you that, then it means that, okay, this company is going to be in existence for the foreseeable future. It is not going to liquidate now or then, unless otherwise stated. But with this concept, it tells us that the company or the entity will continue to exist for the foreseeable future. That is the going concern assumption or the going concern concept. So they are asking us, why use accrual accounting? Why use accrual accounting? That is the GAAP, the general accepted accounting principle. Business require periodic, timely reports. Accrual basis accounting better measure a firm's performance than cash flow data. Because you see, with accruals, they measure as and when as and when the incident has happened, not as and when they have received money. Even they can receive the money, but they may not record it because if they record the money, so they will indicate that this money is not for them. They only take their share when they have performed that particular tax. Assuming maybe you have paid electricity for, let's say, 1 year. Now, no, let us use ourselves as an example. You have a company that client has paid you money for the whole year. Now you need to every month perform some tax to them. So the 1 year, maybe they gave you 120,000 Ghana cedis, which 1 year is 1,000 Ghana cedis. So, sorry, every month is 1,000 Ghana cedis. So you only recognize it when you have performed the tax. So the 120,000, you receive it, but it's an unearned salary or unearned revenue. So you only record the 1,000 when 1 month you have performed it. The second month when you perform, then you recognize it. So it shows the clear future or the clear value or the profitability of the company. The time period concept. The life of a business is divided into distinct and relatively short time periods. So the accounting information can be timely, generally 12 months or less. So this we normally do for accounting. I know every year, then we just prepare it, unless with management accounting that you can do it either daily, weekly, quarterly, or monthly or yearly. But with accounting, every year there must be a balance sheet or a report showing the status of the organization.
Boss.
Yes, sir.
The accrual, it measures only performance. The
accrual, we only recognize revenue when we have performed the tax. We have an example somewhere, we will solve it.
What if there is a bad debt?
What if we write it off? Bad debt, we write it off so bad debt become an expenses to us. So bad debt will become an expenses in the statement, in the income statement, and also will be shown in the balance sheet as a liability.
Okay, but before, when you record the performance and the revenue to be collected, you didn't know there will be a bad debt, and then later in the future you realize that particular record was a bad debt.
That is
so. What I'm asking is,
okay. So we have provision for bad debt as well. in preparing the balance sheet or the income statement, we have provision for bad debt. A company generally provide that, oh, we think so and so amount may not be able to be recovered. So they provide such as a bad debt. So they are also sometimes you see provision for bad debt. It doesn't mean that it is bad debt already, but they have provided it.
So is discount a bad debt rebate?
This discount is not a bad debt, but it's an expense. Bad debt is money that you are unable to collect.
To collect, okay.
Yes.
Okay.
But when you give a discount or a rebate, it's an expense to you, but not a bad debt. Okay. So defining accrual, a system of accounting in which revenue and expenses are recorded as they are earned and incurred, not necessarily when cash is received or paid. So you see, not necessarily cash is received or paid, but it's only recognized revenue and expense are recorded as and when they are incurred. It provides more accurate picture of a company's profitability. Statement users can make more informed judgments concerning the company's earning potential. So with these people, with this principle, we recognize as and when it has occurred. Not necessarily say you paid us 20,000 Ghana cedis. Oh, we have made so and so. No, they only recognize it and record it as and when it's being occurred. Okay, we have performed first month. We have performed our task. It is 1,000 Ghana cedis out of the money that has come. Then they'll record that money as our revenue. Then they record the expenses that they have incurred. So they do it as and when revenue and expenses are recorded, but not necessarily you send the money and they record the money as a revenue that they have earned. So revenue recognition. Revenue are recorded when two main criteria are met. The earning process is sustainably completed. Cash has either been collected or collected in reasonable as assured. So it's only when you have performed the tax and you have getting the money that you can recognize revenue under this principle. That is why they don't just record the money when you send it to them, but they record the money only when the revenue and then the expenses has been recognized. So the matching principle, cost and expense. All costs and expenses incurred in generating revenues must be recognized in the same reporting period as the related revenue. This process of matching expenses with recognized revenue determines the amount of net income reported on the income statement. So they match the cost and the expenses with the revenue. What cost brought us this revenue? The expenses of doing something, the cost of doing something, they match it to the revenue of that particular transaction. So the cost and expenses to it related revenue are down there. Cash basis accounting. Revenue and expenses are recognized only when cash is received or payments are made. So this one is a bit similar. There's a thin line between this and then the accrual. We will do examples so that we will understand it. But with this one, revenue and expenses are recognized only when cash is received or payments are made. So with this place, unless they receive cash, as soon as they receive cash, they recognize it. Mainly used by small business, not an accurate picture of true profitability. So with with this accounting principle, they recognize revenue and cash only when, even though they have incurred expenses, they will not recognize it. They will only recognize it only when you pay them the money. So we will do an example. We will see how it works, and then how the accruals also work, and then we will see the difference between them. So this is the clear example here. During 2010, Crown Consulting billed its clients for $448,000 US. On December 23rd, 2010, it had received 41,000, with a remaining 7,000 to be received in 2011. Now, total expenses during 2010 were 31,000, with 3,000 of this cost not yet paid at December 31st. Determine net income under both method. So the 48,000 is the amount that the clients they need to pay. But as of 2010, they received only 41,000, with a remaining of 7,000 to make it the 48,000. The total expense during the 2010 were 31,000, with 3,000 of this cost not yet paid at December 23rd. So, see, with the cash basis, they received the 41,000. So, because the 41,000, it had received 41,000. And see, cash basis accounting, they recognize it only 41,000. They only recognize revenue and expenses when cash has been received. So they recognize the 41,000. And then the cash disbursement, the expenses that they have made. See, 2010, they made expenses of what? 31,000, with 3,000 of this cost not yet paid. So it means that they made the cost of 31,000. The 3,000, the client has not paid that cost, the expenses. So for them, they have less it from the 31,000. So the 31,000 minus the 3,000, giving them the 28,000. So when you less the 28,000 from the 41,000, they are showing us 13,000. Let me go over this again. With cash basis, they only recognize cash and expenses. They only recognize revenue and expenses when cash has been received. And as at 2010, they had only received 41,000. So they have shown their 41,000 here. Sorry, 41,000 here. And they are telling us that this 2010, the expenses that was made was 31,000. But client has not paid all the 31,000. They are left with 3,000 to pay. So for them, no, the cash basis, they have to less the one that client has not paid to from what they spent. Even though they have spent 31,000, they are telling us that because money has not been received, they won't recognize it. They are only recognizing the expenses that they have paid, which they were supposed to pay the 31,000, but they paid only 28,000, left with 3,000 for them to pay. So they recognize only 28,000 here. But with accrual basis, revenue end, the revenue was 48,000. Now, for them, they will only recognize the expenses incurred, even though client has not paid all the 31,000. They have recognized it because it has expenses that they have incurred already. So they have incurred these expenses. So they will recognize all the 31,000. Unlike the cash basis, they said no. For us, we will only recognize the one that they have paid, even though they have paid 28,000. Accrual says that no, for us, all the expenses that we have incurred, we are recognizing all here because we have incurred that expenses.
Boss,
Yes, sir.
boss, please, yeah. What's the difference between the cash basis accounting, and then the revenue recognition? Because the revenue recognition said you recognize when cash is paid or when cash is reasonably assured, right?
Mm-hmm.
But the cash basis accounting, you recognize cash only when it is paid.
Mm-hmm.
Right?
The cash basis, all these people, they recognize revenue. It is two. The cash basis accounting and the accrual basis accounting, all of them recognize revenue, but all of them recognize the revenue in different aspects. And all of them recognize expenses in different aspects. With the cash basis, they only recognize the revenue when cash has been paid. So you can see here, it had received 41,000 with a remaining of 7,000, even though they were supposed to receive 48,000. But the client has paid only 41,000. So they only recognize this revenue. And then now, when it comes to the expenses aspect, they have spent 31,000. But client has paid, clients are still with 3,000 of this cost not yet paid. And the client has paid only 28,000 out of the.
I understand though. I understand. What I'm saying is that for the accrual basis, whether cash is reasonably assured to be paid or not, you still have to record it.
For the accrual?
Yes.
Yes, they record
whether
it.
cash is assured or not, you have to record it.
Yes, they record it. And all the expenses that they will incur to, they record it. Either you have paid or you have not paid, they will record it. But with cash basis, unless you have paid, they won't record it.
It's clear. It's clear.
Okay.
Please, how did you get the 28,000? I'm confused. Can you please explain to me? Thank you.
Okay. I think I'll explain that. I think some of us are tired, so we will just do some few minutes in addition, and then we will just close the class. Yes, the 28,000 in cash basis accounting, they only recognize expenses when it has been paid. You see, the total here, when you are reading from here, the total expense during 2010 were 31,000. Rate 3,000 of these costs not yet paid at December 31st. So with these people, if the expenses is 31,000 and still you have paid, you are left with 3,000 to pay. For them, they won't recognize 31,000. They have to less the one you have not paid, which is the 3,000. So the 31,000 minus the 3,000 is giving us the 28,000. But when it comes to accrual base, they are telling us that so far as they have incurred the cost, they have to record it. Please, are you clear?
Yes.
Thank you.
But Sam, please, what if they did say the 3,000, but it was only 31,000? Is it possible?
Yes. If they say that during 2010, the cost or the expenses were 31,000 without something, then you write the 31,000 because it means that they have paid all. But this one, they wanted us to know that even though we incurred 31,000, client has paid. Client still has 3,000 to pay, but they have not paid all. So you have to know the difference. But if they don't bring the 3,000, then you record the 31,000.
Thank you.
Yeah. Analysis. Financial statement analysis help users to make better decisions. So with financial users, we have the internal, we have the external. The internal are the managers, the officers, the internal auditors. They are able to make informed decisions about this. How is the company performing? If you're a manager, you use this to be able to know your performance as well. The officers as well, they use this to be able to know where they are lacking behind, to be able to do some changes. And then external users are the shareholders, people who have invested in your company. They need to get, when they get this, they advise themselves whether they should continue on working with you, or they shouldn't continue working with you. The lenders or your creditors or suppliers, when they see the performance of your company, they decide, do we still continue doing business with these people? Do we still credit them with our goods, or we should just find our way? The customers as well. When you are doing business with a company and they are not performing, customers also advise themselves whether they should continue working with the company or they shouldn't continue with the company. So basically, these analysis that we are doing all helps both internal and external. It helps us to make informed decision or better decision about a particular company or the performance standards of a particular company. So building block of analysis, we have the liquidity and an efficiency. Liquidity and efficiency, ability to meet short-term obligations and to efficiently generate revenue. So it tells us the liquidity of the company, the ability, how strong the company is, how strong is the company will be able to, when we did the financial ratio, it tells us how they can be able to recover in terms of their assets, in terms of interest, loans. All this tells us the solvency, ability to generate future revenue and meet long-term obligations. The profitability, ability to provide financial reward sufficient to attract and retain financing. And then the market, ability to generate positive market expectations. So this building block analysis, this is basically what we deduce from this company. At least we think that they have the ability to recover debt and all those. So we should continue. So thank you all for joining my class. I really appreciate your time, and then thank you too for at least honoring my invitation and then joining my. Bye-bye.
Bye.